Welcome to yet another episode of Shortcast over Coffee. Today we have with us Karthik Reddy. Karthik is the co-founder of one of India's largest pre-seed, pre-series A funds, Blume Ventures. Welcome Karthik and welcome to Shortcast over Coffee.
Thanks. Thanks for having me.
Great. So you started Bloom in 2010 and it's been 15 years, quite a long journey. And you started the fund around the time when, homegrown VC funds were not that common in India. Uh, you were maybe 4 or 5 years back in India after a stint in the US. Uh,
Yeah,
how did you dive into this because it was such an uncommon territory back in the day?
yeah. I think the quick backstory is I landed up in the US, kind of very keen to experience that economy in that country. Somebody recently asked me, as recently as yesterday, did you ever plan to come back? I thought most people who go there with the intention of emigrating there. For me, the MBA was a route to get there, but I don't think I'd made up my mind either way. So I'm not saying I knew for a fact that I wanted to come back, but I was just fascinated by the universe I landed into. So it's like sometimes when you land into certain environments, how they influence you. And I landed into the dot com boom, 99. And everything that I thought of I'll do in finance got shelved and everything dot com sucked me. So I was there for my summer internship. I was doing Silicon Valley treks with my B school program. And it was so seductive that I wanted to be in that universe somehow. But by the time I graduated, everything had crashed. So every attempt to try and stay close to that ecosystem was kind of half-assed, for the lack of a better phrase. Right. So I joined the tech bank. They threw all of us out by the end of the year. This was 2001, and then 9/11 didn't help. A whole bunch of things didn't help. My visa situation didn't help. So somehow held on because I thought it was too early to give up on that dream and stayed for another 3 4 years till 2006. But that itching, nagging feeling that like you're not in consumer internet, you're not in digital, you're not in telecom infra. These were all places I tried to get hired into when I was graduating in one. Kept niggling at me. The company I worked for got bought by Nasdaq, so true fintech company like Instinet, owned by Reuters, which was a confused parent, and that to me was like a trigger. It felt like there was a signal, right? I mean, the joke is like it was the same time Swadesh released, but my point is, it was. I think in my head I'd made the call before Swadesh released, right? So this was like a validation movie types, right? That we देश में जाके कुछ करना. And March 2006, I was here. I'd already done a bunch of interviews. Very disappointed by corporate India at that point because I came very close. There was verbal commits, there were handshakes, but nothing. You would take the plane and go back, and they would all vanish. They wouldn't communicate. So bizarrely, ended up becoming a TMT banker in a boutique firm called SSKI, and within a year, they got acquired by IDFC. So I was like, I mean, no one wants me to be stable in some sense, right? So bizarrely, joined the Times Group, which was old school media in that sense, but gave me a very good cover of like what's going on in new consumer because I was a part of Brand Capital, which looked at all consumer facing businesses. Anything that touched media, I had a view on in some sense because they were using the English media to grow. So anything which is India 1 and 1A, as per my colleague Sajid, was an interesting thing that you could experience and view as a market observer. Not surprisingly, Sajid was my colleague there, so was Ashish. So we're all somewhat Times Mafia. So I think Times was meant to happen if you look at the fate of Bloom. Like 4 or 5 of the leadership are of the 10 are from Times, 4 of us from the same group. And Times also bizarrely set me up as the corporate member into the angel networks. So they didn't know what designs I had, I guess. So they very innocently put me as the rep out there, and which meant that I was deep now into Mumbai Angels and Indian Angel Network. We used to host Indian Angel Network Mumbai participation through the Times office, right? So it was, and that was my like dive back into the startup world, and it felt like, how is it possible that there are like these 10, 15 firms, like you mentioned, mostly Valley inspired. I won't say they were all valley names. Like today, what you see is Kalari, Chirate, Nexus, Elevation. They're all valley inspired. They were also sort of uh, native in that sense. Some were valley borrowed brand names. But everybody wanted to cut $3, $4, $5 million checks, which, by the way, 15 years ago was a very large sum of money, even at 50 rupees to the dollar, not at 85. It's become very casual nowadays for kids to ask for that kind of money, but they don't respect how little was given back then. And we said, how is it possible that there's angel groups and literally four of them in the country? Hyderabad, Chennai, Indian Angel, Mumbai, that's it. There's no other angel group in the country. And there's these guys and there's nothing else in between. So to me, it was a combo of passion for what you want to do, which is work with early stage founders, and a natural gap in the market, like a good entrepreneur would sense. If you ask me now in 2024, what have we evolved to? It's essentially not like seeding, looking only at the market gap per se, but like really continuing to obsess about wanting to work with early stage founders. And that market keeps shifting, so you got to find your place. We are not who we were 14 years ago. There are 150 people who have replaced us on that. The market has just exploded, right? And so that was the beginning here. And so I think we went with the idea of we don't want to be mom and pop. We don't want to be a hacky job. So we want to be institutional. We got like a SEBI license first quarter of 2011. So next quarter is like our 14th birthday. So, and so we were like legit from day one. SEBI approved. We were a DVCF, one of the last DVCFs of that regime. AIF came in 2012, which is when we had to stop fundraising after 18 months and said, whatever is there is there. And we had hit the 100 crore mark. So we were grateful, thankful. We closed the fund. And that was the beginning. That was the start.
That's crazy. I mean, I noticed that you guys have a 40-60 ratio, Indian investors versus overseas. How do you go around convincing investors overseas to invest in India, and what do they tell and what attracts them to invest in India?
They're still not very attracted, to be blunt.
Hmm.
So I
Why
think,
is
I
that?
don't know if you know this, but first 4 or 5 years was only Indian money. And when you went to the overseas guys, the answer was typically two-pronged. One is you don't have an institutional track record, and we are not interested in backing like a startup of a fund universe, right? The only people who would do that would be similarly like angels, HNIs, and family offices. For them, it's a trust issue. They don't know shit about whether you're going to deliver or not. And the results are 8, 10 years away. So what do they know? They see you as an agent of taking some startup risk in India. The problem with most family offices and HNIs are they believed whoever was interested in the asset class back then believed they would rather take direct access through those same relationships rather than take a fund which takes 2 and 20 in the way and says that they can outperform them on total. So unless it was an asset allocation problem, not too many family offices like this asset. They want to play directly, right? That leaves the institutions, and the institutions don't touch things which don't look institutional from a fund perspective. Like we didn't look institutional at that point. And the final rub is that if I have to play India, I'll find a more comfortable name and zone through which I can play India. So there's actually one investor who was an investor in Tiger and Sequoia. So for 10 years, they said, and they like to play directs, but come after Series B and C. So we have everything we need. We have market know-how. We have 2 managers. So why add a manager, right? Like, so what is the value of putting 10 million into me, right? So, which is why I'm now gravitating towards more and more institutional, large check, global money, which is fully aligned with me. Because if you think about a startup, so my proxy for funds 1, 2, 3, 4 is the same as a startup's angel and seed round, Series A, Series B, Series C. I've reached about Series C right now. What is the holy grail for a manager or a fund management house to reach? The same thing that a Dipinder or a Piyush Goyal is looking for, which is a public company, right? Then your options open up, you get professional talent, you build continuity, you can be chairman of the board, you can run 10 other businesses, you can buy businesses, you have currency to buy businesses. That's how a startup's eventual growth path looks like. And you adhere to it in our pre-chat that fundamentally, what are you doing all of this for? So that you can leave a legacy and the startup can grow beyond you, right? So similarly, if I had to apply that now to the fund house has to start exhibiting those kind of characteristics for an institution to look at you. They're not interested in playing 10 million and seeing 30 back. By the way, the natural institutional bent of mind is, can I play 3 funds of this guy? That's their IC pitch, boss. Not like, can I play 1 fund? What is 1 fund going to yield? I don't know outcomes for 10 years, right? So I'm playing this fund, next fund, and the next fund. Which means, is this guy and his team good enough to be able to absorb 10, 15, and $20 million over an 8-10 year period, which means, where are we at now? $45 million, and return $150 to $200 million to me, then this fund is a needle mover for me. And just by the way, by the time that last money comes, it's year 18 or 20, in what I just described. So that ask to know, really, I think this guy and me are ready for a relationship for 18, 20 years. That too, in most places where the custodians themselves don't know of that money, don't know whether they're around for 18, 20 years. He's an employee, boss. It's not his family. It's not his endowment, right? So he might be a trusted employee, might want to be there for 20 years, but even he doesn't know that, or she doesn't know that. So when they're looking at us, they're saying, I don't want to make a decision that the firm later thinks was terrible, or the endowment thinks it was terrible, right? So they go to safety first, and therefore they pick managers that are easier to defend to their IC. So I would argue that the homegrown crowd has probably not gotten more than 5-10% of all institutional capital that's come into Indian venture over the last 50 years.
Hmm. Yeah,
it's not like we don't have money. We have money. We have. But if you put it in context of how much those guys have raised, like if you look at Peak at 2 billion or like Axel at 700 million, 100% of it is overseas institutional, right? Compared to, for me, in my biggest fund ever in my life, which is 290 right now, 180 is overseas and not 100% of it is institutional, right? And so you put that in context, how little are we compared to what has been given or, to folks who have validated that for them. So they were, like when you went and said, no, I can compete with Axel or Peak or Elevation in terms of returns, they'll say, buddy, those guys haven't delivered enough yet for us to come and double down on India. They're delivering it, but if they deliver it, I'll give them the money. For me to give Blume the money, you guys have to beat them or have a chance of beating them, and or beat American VC number 13 who's on my GP list. It's much easier to just take a 2-hour flight and figure out American number 13 delivering me 22%. Why the hell should I take a 24-hour ride to India over a hop, come to your place and give you that money to get the same 22% with dollar INR risk, with depreciation? It's like, I don't know whether I want to deal with all of that. And really, you guys have so damn outperformed in the last 15 that I have to leave everything in the US and come. So that's the challenge. And for a lot of folks in Asia, China was that proxy for 15 years. So India, boss, was like always, like there's many famous quotes around India, but one of them, which I heard recently again for the nth time, is it's a peculiar country. Ruchir Sharma, I think, used it. Where it's a peculiar country where it disappoints both the optimists and the pessimists.
That's very interesting. Huh.
Right? So you have to somehow, in that middle ground, still outperform, right? So the government might be happy with pace of certain growth because they feel like, hey, we've done better than previous socialistic, policies and governments. XYZ, the stock market might be happy because the large cap is growing at 20%. So as a VC LP is concerned, he doesn't care about all this, no? He's saying, have you beaten the best global fund? Because I'm buying best in tech globally. If I have to buy India market access, I'll pick the Nifty, Baba. It's doing very well, right? So in venture, you don't get leeway. You have to compete with the world's best and win. And therefore, our bar is very high, especially because you get pegged not to some fund, one XYZ in Israel or one XYZ in UK. You get pegged to the US and China.
That adds
And
such huge
yeah,
risks for you, right? I mean, because I mean,
yeah, it does.
VC,
It does.
yeah,
It's a super tough job. I mean, why do you think we have become so open in sharing everything? Because entrepreneurs need to understand it's not like a walk in the park. It's not my money. It's not easy to generate returns. And I'm actually trying to rope them in to the collective responsibility of delivering these outcomes.
hmm.
That's my
This,
objective when I put those things out there.
yeah,
Yeah.
this same mentality will also make Indian investors not look at India, but why would they look at India and not say the
No, two, three
US?
things. I think, yeah, India loves us a little bit more because you can't actually wire out that much money easily, right? You can't. If they could, they would also play the US. We saw that a little bit in the pandemic where everybody was buying Tesla stock, and the people who bought Tesla and Nvidia stock in the pandemic could have done well because they had a lot more time on their hands. They were sitting at home and saying, "Why am I not buying US stock with LRS of 250K?" And I think that was the peak. I don't know whether that is sustained, but there was definitely a surge of that behavior, and it will continue. Like if I want to buy into AI or EVs, I might, if theoretically possible, I would buy into BYD in China, and I would buy into Tesla in the US, and I would buy into Nvidia in the US. Why should I only restrict myself to India tech risk? Most of it which is not public any which way. That's the other flaw in our model. We didn't take enough companies to educate the market on the fact that tech risk can be great to have in your portfolio. And all that has happened only in the last 3-4 years. That's why there's so much demand, and it's like silly demand almost that everybody's like oversubscribed 50 times, 100 times over, because you never showed this risk to me. What were you doing with it in your private hands for like 15 years? India is not a market like that. India's risk taking. Like you throw Bitcoin, there's like a trend line which goes off the charts. You throw a small cap, it goes off the charts. Which means what? People want to see high growth, quick money. They don't want 12% return, boss. They want 18, 20, 25% return. So everyone's playing for that paradigm. But what's happened is in India as well, when they give money to a manager, and they're giving it because they want exposure to that asset class. Are they betting the house? They're not. It's usually 3, 4, 5%. And then the smarter guys are essentially setting up small family offices, which you've seen an explosion of, formalization of the family office concept. And they're trying to buy direct risk because it gives them two things. It gives them the leverage of getting more exposure into the sector, and doubly rewarding because it actually doesn't pay you. You don't have to pay fee and carry. Right? So essentially, if you play 5 million to managers and 5 million direct, you've actually got $10 million of exposure at half the cost. And you've got used us as quasi bankers to show you the deals for free. Right? And so the Indian guys have that is the balancing act. And they don't have dollar risk. So if you deliver them 22, 24% rupee return, and they get a handful of direct companies which actually also mimic that same 20%, they'll be very happy with you. This is where we would like all our Indian backers to be by 2030. It's all work in portion. Most of them jumped in. A few of them jumped in before 2018. We've returned money on Fund 1, but there's a lot of people who jumped into opportunity funds and continuity funds after 18. I would love to make all of them money, and then they should sit and say, these guys actually know how to make money. This asset class does make money. And if you see the buzz now, that's what I said, they'd rather not play a manager or an early stage risk. They're beginning to buy more and more closer to IPO risk. The fact that this month, Zepto could raise $350 million from Indian family offices within 60 days is mind-boggling to me. That's what I'm saying. What are people smoking? There is a lot of risk appetite in India, right? But you have to package the asset class well. If you say it's a 12-year fund, blind pool, and that's what I'm offering, they say, "वो सब ठीक है यार. I'll give you like, चलो 5-10 crore देता हूँ. तुम सब माल दिखाओ मुझे." Right? And that's the that's the Indian investor for you. We don't have a large institutional base, so we can never depend on India to build sustainable, long-term institutionalized funds. Which is why I'm on a plane, I have to go abroad, I have to go and look for that money, and keep trying to get better in terms of the composition of LPs. And it's a virtuous cycle that you have to put in motion. If you don't deliver returns, they don't give a damn about allocating to India. So that's the final nail here, right? To your original question. Why is it so difficult? It is difficult because you haven't delivered in spades yet. The minute you deliver or you've returned their money, it's like an automatic tap boss. Just keeps recycling, right? And that's what the Americans and Chinese, the best in class managers have achieved. It's not like, by the way, every American or Chinese manager does well. We're talking about same top decile, top quartile. Everybody else sucks by because it's a finite number of large wins that you can generate in a decade. Just because you throw more capital at it, more invention, discovery, and more market cap cannot be created, sir. There's finite buying power in a local market. There's finite buying power in a tech market, and there's finite market cap creation possibility in a decade. First, everybody has to understand this, and that can only get distributed amongst the top VCs. It can't be democratic that the 1800th VC is also doing well as the 18th VC. So even in the venture fund world, there is a power law. So the biggest LPs say, why the hell should I play some random guy from India? Are you in the power law? Can I say for certain that you will be an ingredient of that top decile power law globally? Then I'll play you. And the Indian investor is trying to do the same, but with Indian managers because he can't invest into some Israeli fund or Chinese fund.
Yeah, I was listening to Vinod Khosla talk, and he says that he looks at high risk, high reward. I think pretty much everybody does, and he already knows that 90% of all his investments are gonna go bust, but the 10% are gonna compensate for the 90%. But you're saying that that ratio need not be true for all VCs because there are so many. It may be true for the top 1% of the VCs, but not everybody, right?
Yeah, but
Yes.
actually the ones where that happens, ironically, are the ones that outperform. Because they actually have gotten the biggest wins of the decade. And that's the only outcomes that matter. The other stuff that you're talking about where they're neutralized or democratized, the wins are democratized and there are 18 companies which got 5-10% of the fund back each. That's a 1.5x fund. How is that a great fund?
I see.
So the ones where you get multiple lukewarm winners actually are underperforming ones, not the other way around.
Okay. Hmm.
So that job is private equity. That's not for venture. So venture, the more and more sophisticated your investor base gets, the more and more you hear that we pay you to take the craziest risk on the planet. Don't dumb it down for us. Right? And so if I had to take that dumb risk, I'll play public, no? I'll play private equity. Why do I need to play you?
That is true. So at Bloom Ventures, do you guys have certain sectors that you prefer going after? Because a lot of VC
No,
firms
yeah.
like
I think go ahead. Finish it.
no, I mean there are some climate tech based VCs now. There are
Yeah.
sector specific VCs, um,
Yeah.
and because you are playing this high risk game,
Yeah.
do you usually go general or do you go
We have chosen
specific?
to continue to be generalist.
Right.
I can't say what might happen after 2030, but I've pledged to stay the same for the rest of the decade. So our playbook is what Fund 4 threw at us, accidentally or otherwise. We got oversubscribed, got to 290 million. It's going to be a similar size fund for Fund 5 and Fund 6. So that way if we get those two funds done, we'll have a very similar playbook till the end of the decade. Partnership will be kind of intact. We're trying to groom another layer of young managers. So we'll recalibrate when we get to 2030. Right? For me to have a claim to put more money, I need to be able to deliver outcomes first. That is step one. Now, within that 250 to 300 million fund, we have become very consciously partners are sector specialized, but the firm is generalist risk. And a lot of firms which, when they reach that size, I think have to get there because your competition, to your point, has become sector specialized. Right? So you're right in what you just said, but if you actually dig even deeper, if you look at every new micro VC or sub $300 million fund fund house that has formed since 2016, 50 to 60% of them are sector specialized. So 2-3 reasons for it. One is as the market becomes more sophisticated and complex, you can't context switch that easily to do climate one morning, SaaS the next, and consumer the third, and fintech the fourth. If you're asking a partner to do that, that's not possible. Now, at a firm level, when you're a small fund, you can't also divvy up like this and actually win multiple sectors. Third, as a new brand, which has originated only in the last 8-10 years, you got to pick the battles where you can win, not try to be a hero and be in every battle, right? So a combination of founder persona, what they're passionate about, what the market opportunity looks like, and the need to specialize has forced most funds to specialize. We had the luxury of being a slightly older fund and be generalist, and we have grown to a size where I can actually have a meaningful amount of dollars given to a partner to do one sector. So I can do 50 to 60 million only for SaaS, 50 to 60 million only for climate, 50 and deep tech, 50 to 60 only for fintech, etc. Right? So that's how actually Blume is divided today. So I do tell my LPs that whether you like it or not, if you play Blume, you will get a generalist slice of India. And you can be assured that each of the partners is aspiring to be best in class in their sector. Right? So if you compare our pitch track record, it should look like the best deep tech, climate tech fund in the country. So apples to apples, I'm willing to draw that comparison and be very bold on that. We're not trying to hide behind each other and say, "Oh, I didn't get any hits this fund." You know, I'll hide behind Arpit's track record, or Sanjay will hide behind Karthik's track record. No, you have to build your own track record because I have to justify why I gave or why we allocated 50 to 60 million to that sector. So it's an interesting dynamic because we've gotten to that scale today finally. And that's what we propose to be till the end of the decade, at least. And then we'll calibrate on whether we should give up sectors, add more partners, give more dollars. All that decisioning we can do then. But I don't see an urgency to do that. I'm happy in this current steady state. So that's where we hope to execute Fund 5 and then Fund 6. I think if I were a younger manager today, I would specialize. Right? I don't think you can play all these sectors that easily. It's not easy. You have to go and compete on agri with Omnivore and Ankur. You have to compete in deep tech with Pi and somebody else. So you can't, if you're a 50 or 100 or $120 million manager today, you pick your strengths and go after them. Because you got to win on everything. You got to win on content, thesis. Why today people don't come because XYZ doesn't come only because of the air cover of Blume. Within Blume, then they need to know who's the partner who's going to sponsor them and work with them for 10 years. Right? That was different when there were two founding partners and everybody thought they had access to both partners. Now everybody won't have access to me. They'll have to work with somebody else in the firm. That person has to have the same brand recall in the market as I do for his sector. We don't have a her in partnership position yet, but we'll hopefully get there soon. But I'm saying that's how the firm has evolved. So, and since we're touching upon it deeply, Blume has always sold this idea that we are 60. The 60-40 plays out in multiple places. We've talked about the investor mix. 60-40 is also our reserve ratio. So for every if we have 290 billion of the investable corpus, 40% goes to the primary check, 60 is reserves. Similarly, we have a 60-40 ratio for domestic market opportunities and global tech. Things that purely ride on technology sector moves. Like, so AI comes, EV comes, what is whether it's regulatory or otherwise, there'll be a market shift. So we're betting into technology-led market shifts on where tech can be a moat and a differentiator, whether it's software, hardware, etc., life sciences. That's 40% of our bucket. 60% is, yes, tech is an enabler there also, UPI, smartphones, etc. I get it. But the application is not tech. It's a business, it's a danda, it's financial services, it's education, it's healthcare. That we believe that we'll stick to India mostly. Of course, I'm saying that when I'm very proud of an ultra-human becoming a global company, but I would still put it as it's not a health as much. It is health, but it's sitting in a slightly deep tech bucket. I don't think it can be a generalist services business in healthcare and go and attack the rest of the world. It's not easy, right? But if you have a tech moat, you can go and conquer other parts of the world. So we are divided in that fashion: 60-40, 3 partners, 2 partners. We have 5 investment partners.
I have heard you say that you would like companies to see VCs as temporary partners in a
Yeah,
long-term journey. Um,
yeah,
do you feel like 10 years or a decade is like sort of the sweet spot?
yeah, I think so. So I think companies itself should set themselves a goal of naturally evolving. If you're asking for venture money, you're basically trading your life for lower ownership, higher speed, higher scalability than a normal world. That's why you come to venture money. There are 99% of entrepreneurship does not touch venture capital because they grow at a different pace, either because of the characteristics of the founder or the business model itself. When you come and you want to play here, then the rules of engagement of this game are not that you're servicing me for that cute 10-year timeline. I actually believe in 10 years, you should need to figure this damn thing out. Can you make money? Can you be profitable? Can you list? What the hell is it waiting for the 15th year for? Right? You should have figured this out by that path by the sixth, seventh year, work towards it and get there in 10 years. That's part number one. When that happens, there's a natural evolution of the cap table where it actually, once you're close to public, for example, it doesn't matter who's on the cap table. All shareholders are equal. If one of our drivers bought the stock directly or through a mutual fund, or I own it as a VC, we're all the same on the cap table. We have the same rights. We're all common stockholders. We get the same dividend. So I'm saying when it evolves there, how does it matter who's on the cap table? So we can be friends. We can keep having a drink for the next 10 years. I can own the stock in my personal capacity. But I don't think there's a role for the original VC to come there and say, oh, I'm relevant to you or this thing. Doesn't matter. HDFC Life, ICICI Pru, Templeton Fund, Bloom can all be shareholders. Does it really matter to the founder who the hell is owning how much in a public company? Not really, to be honest.
Hmm.
So I think that natural cycle, if I had to push, the 10-year number is quite a decent number. Like you don't need to aggressively push for 6 years. That's absurd. And I think allowing founders to slack off till 13, 14 is also not a good idea. It hits IRR, it hits everything, right? So why venture then? You could have built it. If you get to 20, you don't even need venture, if you ask me. Because you can build a solid, profitable business by seventh, eighth year and then compound a little slowly. You might be half the size of the business, but compounding will take care of it and your ownership will be much higher because you didn't go and dilute silly and take a lot of money. So if you're going to build in 20 years, you shouldn't touch venture, right? And 13, 14 you'll get lazy. So at least the target should be 8 to 10.
Hmm. That makes sense. Bloom has invested a lot in agri-tech and climate tech. Uh, Deep tech. I just want to draw your attention back to deep tech. I feel like deep tech is so much dependent on who is in power, what are the policies at the central level, and also subsidies, right? I mean, for example, um, the whole e-commerce boom that happened in India was because of how Reliance made uh, internet and data accessible. So, do you see in the current scenario that level of foresightedness in terms of making in India a manufacturing hub or investing heavily in climate tech? And how do you sort of perform a risk assessment when someone pitches a deep tech startup
Hmm.
because it is dependent on so many things, right?
Hmm. Firstly, curious coincidence. Had to meet the founder, so I came to the office, and I'm taking the call from his office. I'm using his seat as well. This is Kaushik Mudda's seat of ethereal machines. So he's generously lent his desk to me today for 2 hours for two calls. I'm sitting in the ethereal machines office in the suburbs of Bangalore, Pune. And if you look at their journey, for example, I don't think it had that much to do with regulatory headwinds or tailwinds. It had to do with macro tailwinds for sure, meaning people wanted India. India is a plus one strategy to Southeast Asia, China, clearly emerged in the last 2, 3 years. And the slew of people who want to come and find world class supplier bases in India has just expanded. Like he was just telling me, he had like 4, 5 international clients visit this week. Right. So you do catch a tailwind like that, but it's been a patient wait. Took us 5 years to get here. Now it's exploding, right? So there are, in deep tech, I think the challenge is not as much. I'll come to the regulatory part. I think there are many tailwinds that have to follow. Regulatory is one of them. I would argue. I don't think it's the only one, right? Um, and um, in our experience in deep tech, climate, of course, there's EV and there's everything else. Now, EV is anything which touches Aam Aadmi in this country, right? You have to be wary of where the government is taking regulation, right? They will have a view and they want to control it. And that could be financial services, it could be EV, it could be e-com, it could be like, things like that. So if it doesn't, and if you're export oriented, actually you shouldn't care that much. It should grow like IT
Yeah,
services,
it'll be
right?
encouraged, I guess.
Yeah, yeah. It will be encouraged because it's export revenue. So if you can, and our worldview of deep tech is that there's very little deep in climate tech which gets absorbed in India, and it's so far been predominantly around EVs. Everything else we've funded is actually, even though we were trying to sell in India, we realized our folly, and in 3, 4 years has started to pivot globally. We said agri robotics for cotton farmers in India, Nico Robotics. And we realized, my God, the amount of layers of problems you have to solve to get that product smoothly running at the last mile for the farmer. You go to the US, you have a large farm, you redesign the product, you retrofit it onto these giant harvesters, and they go and spray, and like each unit is like $250,000. So poor cotton farmer, he has to wait. I mean, it's one of us. We haven't abandoned him, by the way. We are servicing that customer. But I'm just saying priority will shift where the dollar shift. That's markets for you. So I'm saying reality is in deep tech, we will not back founders who can't have that global thinking. We took a pause on space. We looked at space before everybody else did in 2018, 19. We didn't believe that ISRO will move that fast. And we didn't believe that Indian founders will be able to compete on a global market in an area like space. Same thing, regulation, will foreign regulators allow it, etc., etc. We looked at the entire space. We looked at 10 different companies, 15 companies, ended up doing one, right, which was Pixel. And even then, a lot of those check marks happened. Incredible kids, got validation from the US. It's US domiciled. They were going after the US market on day one. And then we went in back. And it was a data play, not necessarily a rockets related play. And those sats could have gone up on any rocket. Even if we had built them in Bangalore, we can ship them and deploy them everywhere. So I feel in deep tech, climate tech, we veer towards, can we make this global on day one or day 5, rather than, oh my God, what we were thinking and why are we chasing this for like 5 years in the wrong market, right? And so that's the consciousness that's step in. I don't think the regulations and macro are tailwinds, but you can't budget for them all the time. Forecasting them is very, very, very challenging. So, for example, like in life sciences, I don't think it's about regulation as much as technology that might enable faster drug discovery or faster testing or faster ability to get to the US. So we looked at dozens over the last decade. We've never done a single one in life sciences. But now we're looking at healthcare, which is not life sciences in that sense, but it's digital therapeutics, which is essentially using an app. FDA has a much lighter regime. So we have taken 2 bets in that space, by the way, because we actually believe, and we're looking at a third one, because we actually believe that light touch model will allow an Indian company to win in the US market. A deep touch company, we are not willing to take that risk, because by the time we figure out all the regulatory, hurdles, we'll be in year 6. So we have to calibrate. This is why I like our diversified approach. I don't lose sleep over it. Okay, we won't do deep tech this fund cycle. So what? I have 5 other things to do, right? If you're a deep tech fund, you have to obsess only about these, right? And I like this flexibility we have naturally baked into the model for this reason. No losing sleep on one sector or the other. You should be picking winners in half a dozen sectors. Like seeing these trend lines in a 3-year period. That's what fund construction is.
Yeah. Having such a diversified approach would also mean that you would have spoken to founders from all spaces. What are some of the things that founders find the hardest to deal with? I mean, I can give you one example from hosting a podcast for a year, and some of the founders have told me that it's far easier to raise money these days. Like I could just send a few emails and I could get millions of dollars in my bank account, but the harder thing is to find technical talent that can put their head down and solve a problem. What are some of the things that founders have told you? Because
Well,
I'm sure
similar.
that
I think
mentorship is also a huge part of VC
it's a
startup
bit of
journey.
everything. I wish there was a standard answer. So you're right. It's going to be multiple reasons. One is sometimes markets are not ready, or at least because I do really early stage. PMF is not as easy as people think it is. Meaning getting right product, right market, right pricing, and getting that right sometimes takes 3-4 years. So whether you have talent or not, that the market tells you. These are market linked factors,
Hmm.
right? So people discount how challenging it is to get that, you know, understanding of the market. Like the guys who do it best are probably guys who worked in financial services or SaaS, because those market needs don't change as dramatic. But if you're doing something in deep tech, you have to go and discover. Like you might have a great product, you don't know how to price it or distribute it. Sorry, we haven't even touched distribution. So I'm saying selling, market, which geography you have to be in. All of those are market linked problems, which are non-trivial, if you ask me. Right. Second layer on that is if the founder has not done a somewhat scale PMF in their life before, is all new discovery. Right. So, for example, I'm saying if there's a SaaS founder in this month, in today's world, who has not actually been someone who's a product manager or a sales guy or a CEO of a company that at least got to 10, 20 million ARR, can they actually have a very high probability of building a 100, 200 million ARR company? This is what I'm chasing. I don't want a $10 million outcome. That was fine for my fund one. It's not fine for fund four and five, right? So I think these training models and lenses were non-existent before. So when you hear these, it's because nobody was exposed to those kind of opportunity sets before. Today, you get a kid who's gone in 3 years, he's built a category in Flipkart for $100 million of GMV, right? Or he sat inside of Nutanix and built a $10 million revenue line. So this is getting easier on the market front. Now, the corollary to that is, unless they've done what I just said, how do you know how to talent up the firm to actually build to that scale? So most founders in my limited learning and experience struggle to scale every orbit. So it's not about fundraising, as you rightly said. It's about, as you go from seed to A to B to C, it is the ability to scale an organization that keeps up with the need to keep that multiplicative factor in revenue and growth happening. So the founding team is fantastic that you sometimes can build a great founding team. How many examples do you want to hear or see of founding teams being irrelevant outside of the CEO by the fifth or seventh year of the firm? Right. So it doesn't matter whether you call yourself founder or not. Can you scale to that speed is what is most important. Even in a venture fund, we are finding that challenge. We have to evolve. I can't be who I was 7 years ago. Right? Writing very different type of risk. I was doing very different things. So even the talent that we look for has to be able to adjust to a new calibration of risk. It's not about writing 200K checks anymore that 150 micro VCs are doing in the market. If you want to be that, you have to go join them, not Blume anything. Right? You have to be able to say, can you chaperone a company, put them on a path to $100 million valuations where beyond which they can get to $1 billion? Product has changed. In Blume, the product has changed. For us, product itself has changed, if you ask me. Though it is early stage, the end product has changed. Similarly, in these companies, I don't think the challenge is about. I would actually say, a lot of the early stage risk prices in the amount of dollars or the valuation to be paid to the founder bases their actual ability to hire and attract talent. which is why a second time founder gets a premium and gets an $8-10 million seed round, because there is not too many doubts about their ability to do so. They have a track record and a brand which will naturally attract the talent. And then you add a layer of a Blume and XYZ did 10 million seed in it. Boom, all the talent lines up because they don't even have to worry about not having resources for the next 3 years. So they're raising 2 rounds at the same time. Same thing if you go to a first time founder who has no network, comes from a no name college, what you said is not true. They'll struggle to even raise $500,000
Is
because they
pedigree
don't have
important?
networks, they don't have talent.
Yeah, is
It's not about
pedigree?
pedigree, it's about networks, right? So I think eventually pedigree shouldn't matter. And I think enough exceptional stories out of India will get written without the pedigree. The problem is the biases are there in the ecosystem. I'm not saying there aren't. We exposed some of that in Omega Files 1. We don't know. You can't, there's a correlation, causation, you don't know. But if you look at all our AB funding, a preponderance of that went to IITA and BitScience, right? Didn't come to the other folks we had picked. But we picked fairly democratic, 50-50%. No, are the biases mine? Are the biases actually around the performance? Or is it actually that the biases creeped in from later stages and never funded those people? We don't know, right? So only end state, you have to overcome. See, everybody has to overcome biases. I'm a homegrown fund. Biases are there. I'm trying to overcome them and still win, no? I would say I didn't have that pedigree, no, in my own way as a GP. So what if I went to fancy colleges? That's not why I'm getting funded, no? Right? So I'm getting funded because I have to show performance in IRR. So I think eventually it will catch up. I hope to have a narrative in 2030 where it says pedigree doesn't matter shit. Right? But we'll have to wait for enough outcomes. Right now, there is a bias which is played out because funding went to such people.
Yeah.
The
And
VCs
also,
are all from that pedigree.
yeah,
So it
yeah.
doesn't help. Yeah.
Yeah, also you are a VC. I mean, altruism can only take a certain percentage of what you do. Um,
That's right.
I wanted to ask you about hiring general partners. I mean, I've seen some exceptional examples of people who are like, I don't know, 23, 25-year olds becoming general partners. I know there may be exceptions, but like, how do you go about hiring? Because it's such a huge responsibility. You are
I think
entrusting.
I think the firms who do that want to grow the firm faster, is what I've realized.
Hmm.
Right? You're filling the need for the firm's growth artificially by giving that responsibility much earlier. We have not had that luxury. 20 million, 60 million, 100 million is not a fast growth firm. There's not enough dollars to go around the table. You have to have dollars and reward mechanisms that can actually sustain someone like that. So I don't expect or suspect what you said happening in any firm that doesn't cross $150 million in the first place, right? And it might happen if there's rotation where like somebody senior and doesn't know, can't go to the market where he's saying I'm stepping out and there's nobody to fill my shoes. And maybe the best bet is someone internal, right? So those things typically happen with internal promotions and internal branding. They don't hire a 25-year-old and say it's a GP. So they've gotten enough trust and they're taking a leap of faith, like how sometimes you take a leap of faith on a 22-year-old founder. We took Sajid laterally, but broadly, Arpit grew through what I think is the conventional route for most early stage VCs, which is from within. So we will not artificially promote. Arpit used to ask us every 3 years, and I said, I think I'll know him here when you're ready, and you will be proud of your track record when you're ready, and it'll happen. And eventually we gave it to him, right? But he waited a long time, and I respect that path far better than I can't relate to what he just said. I don't know it. I will not do it. Right. Even with a gun to my head, I'm not doing fake promotions. Right. And I'm not definitely doing it for 25, 26-year-olds. Like they don't know shit about venture capital. They might be smart people. And that FOMO of like, oh, he might go become a GP somewhere else or she might become a GP. That doesn't really matter to me. If you're coming to Blume, if you're partner track, then you have to be for like 20 years, boss. So like, how do I care what you think of me in 1 or 2 or 3 years? Like that's the like teething time. I need to even get to know you that time. Kind of time frame. So we're fairly transparent about it here. We're very blunt. So our math doesn't work that way. I can't relate to what you asked, so I don't really have a great answer for why others do it. It's their choice.
Yeah, I guess maybe only the Andreessen Horowitz, I mean, of the world can do it. Like, these are very exceptional cases, by the way. So,
Yeah, they're exceptional. They're also that's not these are not good examples. That's what I'm saying. You can't take 10 firms in the world which do odd things. They have 6-7 billion. They can allocate capital left, right, and center. They can take chances. So actually, they're basically treating this person like an entrepreneur on which who they would fund $50 million, right? So if it goes wrong, it's okay. They can absorb the loss. It's only one less than 1% of the fund. You know, 7 billion. What's 50 million, right? So I wish I can get to that point, but like that's not how we want to throw money, right? So we will give 1-2 million to somebody who we are training, but like we think of the rigor of training. You saw if you've seen my blog, I believe our practice is like a sushi chef apprenticeship. So you can say I can make the person a sushi chef, but maybe they're geniuses and maybe they'll get it right. But I prefer the Japanese style of taking 10-15 years to become a sushi chef.
that makes sense. Karthik, recently I read about this company called Case Text, which got acquired by Thomson Reuters, 650 million, and they
Hmm.
made this AI legal assistant or like a co-pilot for
Yeah,
legal assistance using GPT-4, and they sold it to Thomson Reuters for 650 million. And this was a company
yeah,
that was around the same space for about 10 years, making like
yeah,
incremental improvements in legal tech, etc.
yeah,
With the explosion of AI, I mean, how
yeah,
can we not talk about it, right? So,
yeah.
do you see such high valuations in short period of time, and does that scare you in any way?
No, I think it's happening whether I like it or not, or whether I'm scared or not. And I think it's happening because large enterprises won't get everything right, and they see for the first time a generational shift in terms of how new product solutions will be AI first, and they can't develop everything on their own.
Right.
And they'd rather buy that innovation fast than like wait on it and lose out that other sector forever. So, like a Thomson Reuters may or may not have had a play in legal. Now, this is an opportunity to get in there early on a new tech that these guys have pivoted to or evolved into very rapidly. So, incumbents in verticals and some horizontals, like so, Salesforce will do what it does with Agent Force, but somebody who's done and understood a vertical and has data and has vertical knowledge very, very deeply can actually go and kill it at this point because the open source nature of AI has allowed everybody to adapt those models very, very rapidly. Now, if I do that and there's no way Thomson Reuters can catch up with me. They have to build from scratch, right? Whereas I've had is 8-10 year legacy. So I think a good, smart SaaS company with a legacy background can actually hit it out of the park, start seeing dollars, the revenue go this way, and then get a massive premium to get acquired. So I feel there's an AI acquisition wave that's going to come like big time in the next 3 years. So if you're on the right side of that by having developed something rapidly and you're filling a gap which the big boys don't have, you'll get a disproportionate premium. And that happens every 5-10 years on a new tech. And I think it will happen in AI. But
Yeah.
eventually, you got to solve a problem deeply. You got to take advantage of the new LLMs and go and say that I'm decimating cost structures and centers and building process efficiency very, very rapidly. And I think there's massive value to be created from that.
Yeah, that's something to for young entrepreneurs to watch out for. Um, Great conversation, Karthik. I mean, I think I can keep asking you so many questions, but
No, yeah,
just
I wish
keep.
we had more time. I also have to jump off, but we
I
leave
know.
something for the next time. Yeah.
Yeah, but very quickly, if you were an entrepreneur, young entrepreneur in India, what would you bet on?
I think it's about, I've always, preach that you should chase something which you can be passionate about for 15, 20 years, otherwise don't bother starting. And for me today, that's climate. I don't know exactly what in climate I would do, but I would do something in that space. I don't want to be tempted by that. I have enough work on Bloom's side. I've taken enough money I have to return. So I don't think about it often enough. But if I were to do it, it would be in that space.
Okay.
And it could be, I we talk about water a lot at home, so maybe it'll be in water. I'd love to get more time. If that would be my first freedom that I get, other than family, if I can get more time, is go and study things, new problem areas in climate, any which way, as a personal interest. I might invest more in that space, whatever it may be. So if I have to start, it would be there.
Okay, perfect. Well, Karthik, thank you so much. It was really valuable.
Thanks.
Thank you. Bye.
Thank you. Thanks for having me.